How's it going, everyone? Matt Leighton. Welcome back to another real estate video. Hey guys, really excited for today's video. We are joined by Rich Conlon. You might have seen him on the channel before. He's helped us out in the past. He is a mortgage lender here in the Northern Virginia, DC area. And today, Rich, we're going to go through the top mortgage lending myths, the things that buyers think are true but are actually not true. So Rich, why don't you take the floor and give us your top 5 lending myths.
All right. Well, first, thank you for having me.
Thanks
again.
for being here.
I always appreciate the opportunity to do these videos with you. I think they are terrific. So, diving right in, some myths that are out there. The most common that we're hearing right now, I'm going to wait a year or two or longer because I need 20% down.
20% down.
For down payment, right? And quite honestly, in the DMV, that's just not the norm anymore. We live in a great market, right? But obviously, everyone knows cost of living is super high when you compare to, the majority of the U.S. So the 20% down is just not typical, especially for first-time home buyers. The average in this region is typically 5 to 10% down. The 20% down, you don't need it. It's not necessarily worth it to wait and buy. Obviously, everyone knows right now we're experiencing a raising rate environment. So 2 or 3 years from now, rates could be, at least 1 to 2% higher if you wait, and that comes with a higher payment. So definitely, the 20% down is the most common myth that we're seeing with most buyers.
Yeah, I think 4 out of the past 5 listings, I just looked it up before here, the buyers did not put down 20%. It might have been 5%, it might have been 0%, it might have been 10%. So definitely seeing a shift there where the mindset was like, all right, I have to have 20% down. Now it's like, okay, well, there's some creative loan programs out there where you don't have to do 20%.
Absolutely. Fannie and Freddie in the mortgage industry as a whole has recognized this. So there are a lot more incentive, less than 20% down programs out there, and Fannie and Freddie in particular have adjusted their risk-based pricing models that on some occasions your interest rate could actually be slightly better with less than 20% down than if you put 20% down.
Wow.
So yeah, we have seen that on occasion. It does kind of blow people's minds, but it is legitimate.
Cool. So that's the number 1 myth. What else you got for us?
Credit pools. That's the next one. Those are, both are probably pretty close. But obviously, it's encouraged that buyers shop, and with that, the buyers are concerned about getting multiple hits on their credit, inquiries by multiple lenders. The CFPB, the Consumer Financial Protection Bureau, right around the market, right after the market crash, it encourages clients and first-time buyers or buyers in general to shop for multiple lenders. They encourage it. So it wouldn't make sense to encourage someone to shop but then hurt their credit scores. So a common myth now, if you are shopping for a mortgage, there is only going to be one inquiry that maybe, even if you don't have credit issues, it actually may not affect your credit score at all. At most 3 to 5 points, and that's maybe if you're on the lower credit tier. But in most cases, may not affect your credit at all, and they encourage that. So they'll recognize you shopping with multiple lenders and will not ding you every time you reach out to a lender and that individual lender pulls your credit.
Yeah, I think that's key because everyone is so protective of their credit score, as they should be. But at the same time, I also think that there's a lot of misinformation and a lot of noise out there about what actually affects the credit score, and God forbid it goes down 1 or 2 points.
Where you can probably see, where you may see like a 5 to or more point, adjustment is if you're shopping for different types of credit. So if you're shopping for a mortgage and you're shopping for a car and shopping for a credit card, that is where you're going to see the significant dings because a car and a mortgage are more secured lines of credit, so you're not going to be penalized. But a credit card, that's where you're going to see more of an effect. So if you're shopping in different industries for different lines of credit, that is something that I would be cautious of and kind of hold off. If you're shopping for a mortgage, don't go open a credit card. Don't maybe not also buy a car at that time. Take it in steps. so that your credit is not affected and receiving optimal scores at each time in each period that you are searching for that line of credit.
Cool. Hard and soft pulls.
Oh yeah, hard and soft pulls.
Yeah.
So obviously that initial inquiry is a hard pull. Again, if you're in the top tier credit level, it's not going to affect your score at all. It won't adjust. In the mortgage process, there are two essentially pulls, a hard and soft. A hard pull in the beginning that obtains your full credit report with mortgage scores. And then about a week before you go to settlement and you close on that property, all lenders are required to do a soft pull, which is just simply a refresh. It's not going to affect your scores. It's just checking for any new open lines of credit that if you did open something new and it affects your purchasability, that could be an issue. But it's required by all lenders that if they did open any new lines, that it does not affect their qualifications.
Got it. Cool. What's number 3 on the list?
The 30-year fixed rate is the best rate or best program.
Best program
for everybody. There is some truth to that because it is, most typically the least payment. Compared to a 15-year or a 10-year fixed. Obviously, since they're shorter terms, the payment is higher. And so the 30-year fix is obviously the more, attractive option. But that's not always the case because not everyone is buying their dream home. Majority of people nowadays, especially, again, reverting back to where our market, the DMV region, most people aren't living in their first or second home for 30 years and usually plan to buy up within 5, maybe 7 years or even shorter than that. So maybe when you're in that scenario, if you're relocating, this is your first house, it's a condo or it's a townhome and not your dream home, an adjustable rate mortgage can certainly be a viable option, just because obviously lower interest rate and the rates do adjust. If it's a 5-1 ARM, it's a fixed for the first 5 years, and then it'll adjust based on where the market is.
Yeah, and I think the goal here is just to keep your options open, because for the longest time, people are thinking, all right, I need to have 20% down, and I have to have a fixed rate 30-year mortgage. And while that may be the case, you may go through the entire process, and Rich is like, yeah, you need this, that, and the other, and it ends up to be 30 years. There's a lot of opportunities out there. So, keep your options open, and ARM might be a good opportunity for you.
Yes, absolutely. They sometimes go with a different set of guidelines. Make sure your lender explains that. But again, it's just a way to capture a lower interest rate, save for those first couple years so that you have that down payment ready for your next big dream home.
Cool.
Yeah.
What do you got next?
The next one is, an online lender always has a lower interest rate.
Yeah, we get this a lot now.
We get quotes sometimes, the big ones that everyone knows, Quicken, Rocket Mortgage, some of those quick, two clicks and you're approved, and you get a little, a sheet that says, here's your interest rate. We pulled we have your credit score, here's your interest rate. Yeah. There is, online lenders, some of those bigger nationwide, yes. Sometimes, they will have a better interest rate than a company such as mine or a local lender or a local credit union. With that though, it kind of goes with, the level of service, what you're looking for. So it comes down to what are your goals, what are your needs and wants through this process. The larger, Quicken and those institutions that may provide us a very low rate, you may have to go through call centers to get somebody. You may be speaking with somebody different each time. And then if you find yourself, again, we're talking about this market, how competitive it is, how competitive a contract we want to make. Quick closings, you could run into issues on that front. It comes down to what is your goal? What do you want out of the process? Do you want someone that you're going to deal with, the same person every time, a level of communication throughout the process? You're probably going to be more satisfied with a local lender that may have a slightly higher rate, but again, if that's what you're seeking and you're not as concerned with just getting the absolute lowest rate and dealing with maybe the potential pitfalls of that process, then that maybe it's a matter of satisfaction.
And I've heard of some listing agents not even accepting Quicken Loan pre-approval letters for offers, just because when you get that letter, it's so preliminary where you've given such little information that they say, yeah, you're pre-approved, but you need to do all these like 20 other things where it's not like a legitimate letter.
Yes, absolutely. That is something that we've recently heard, from those larger institutions, and a client that comes to that's already pre-approved, and we're happy to, provide second level opinion, additional resource. But a lot of times we'll also get the agent that reaches out to us. Hey, the sellers and the listing agent would like to also see a secondary lender letter, or speak with another lender in terms of validating the ability to perform on that offer. So we're always happy to do so, but it is something that that is a very good point that we've seen recently.
Absolutely. Cool. What's number 5?
Number 5. It's something that we saw early on in the year, not so much right now, but is, can I make an extra payment? Is it beneficial? Instead of just making a monthly payment, 12 per year for 30 years, should I stick with that? Can I make an extra payment? Will it be beneficial? Some people talked about a large lump sum, so would it be a recast or principal curtailment? That's ultimately going to be, in terms of a recast or a large lump, principal pay down, that's going to be largely dependent on your your servicer. So whoever you're making your current mortgage payments to, always encourage them to reach out. Every servicer is a little bit different. And there's a small fee that's charged with it. There's also minimums. But when it comes to making one extra payment, maybe a year or a couple out of the year, always encourage. And you don't have to notify your servicer per se, because it's not such a substantial, it's not going to change your terms. It's not going to change the rate. It's not going to change the principal right there. But what it can do is save you interest and shorten the overall term. So, for example, let's say we have a 30-year fixed $200,000 loan. Okay. That's what your mortgage is. Okay. Let's use an interest rate of 5%. Okay. Okay. So over the length of the loan, if you're assuming 12 timely payments, no extra payments, so 12 payments every year for the life of the loan at that interest rate, you're looking at about $186,000 in interest paid alone. Okay. Now let's say that you make one extra payment a year, so you make 13 payments. All right, every year. You're automatically shortening that loan from a 30-year to 26-year fixed. So you shave off 4 years. You're paying it off 4 years, and then in turn, you're saving yourselves over $32,000 in interest paid over the life of the loan. So $32,000 savings and paying it off 4 years in advance, which I think most of us around here, if we can pay something off early and have it off our books, we're ecstatic.
That sounds like a good idea. I've seen some YouTube videos recently and some Facebook ads where it's like, learn how to pay off your mortgage in 5 to 7 years. And I'm like, do I want to do that? Like, I feel like there's something like totally not right about that. Maybe it's bi-monthly payments, or maybe it's an extra payment. And maybe you do that, but maybe your money is better spent elsewhere.
Yes, I would, if you're curious about it, you can always talk about it with your lender during the process. It's not something that is going to be and needs to be decided before you reach settlement. You proceed through settlement, and it's something that you can reach out to your servicer after. It's something that you don't have to do it by year 10 or by year 5. It's something you can set up bi-weekly. You can, just call your loan servicer, talk to them, get the details before. You don't have to make a decision right then and there, but make sure you do call them so you get the full scope of details, because making that extra payment can be beneficial. Like I said, tons of savings and shortening the life term of the loan.
Yeah, guys, there you have the top 5 lending myths from Rich Conlon. What I'll do is I'll list and link Rich's information in the description below. So if you have any questions or if you want to reach out to him, you can do so easily. Rich, thank you so much for joining me.
All right. Thank you for having me. Really appreciate it.
Until next time, create a productive day. Take care.